Hi, I'm Evan, and I'll be taking you through Nike's financial analysis. To get a better understanding of Nike's financial performance and position in the industry, their 10K annual report was analyzed and studied. As learned in lecture, the 10K report includes an audited balance sheet, income statement, and statement of cash flows. These audited financial statements were dissected, manipulated, and applied to generate useful graphs, trends, and ratios to better understand Nike's financial performance. These tools generated via Nike's 10K will walk us through Nike's financial health, position in the market, and help define financial weaknesses. So before getting into the financial analysis, it's important to have an understanding of the dynamics and key financial factors of Nike. As mentioned, Nike is one of the world's largest suppliers of athletic footwear, apparel, and a major manufacturer of sporting equipment. Therefore, their position in the market is crucial and heavily scrutinized. With approximately 65,000 employees worldwide, Nike has a lot of stakeholders who are affected by their financial success. Unfortunately, over the years, attractiveness of companies' financials has been heavily inflated. Also, the boom of the dot-com era has made financial news almost too readily available, which creates a bigger spotlight and more pressure for short-term financial success. I thought it would be value-adding to do a quick overview of Nike's financial statements before analyzing some of the better-known metrics. These statements you're about to see cost Nike a grand total of $22 million in audit fees, so the value and importance of these statements to users goes without saying. This is obviously their income statement, and has shown an increase in revenue over the past 3 years, while effectively keeping operating costs down, as shown by the constant increase in net income. Nike's constant progressive performance is evident in their earnings per share, which has also constantly risen over the past 3 years, while continuing to increase their dividends declared. The income statement provides the revenue and EPS, which are two of the most commonly assessed metrics in assessing a company's financial health. Next up is their balance sheet. Adhering to the ever-so-famous accounting formula, the balance sheet summarizes the assets, liabilities, and shareholders' equity of a company at a given time. These three categories give users an idea to what the company owns and owes, as well as the amount invested by shareholders. Many of the financial ratios we have analyzed root from the balance sheet and can be used to generate useful financial metrics. Ratios such as the current ratio, quick ratio, debt to equity, liquidity, and solvency ratios derive from the balance sheet. The last big three financial statement is the statement of cash flows. Now obviously there are a lot of numbers on these financial statements, and they may not look very comprehensible per se, but doing a financial analysis without showing the source of the information would just feel unjust. Our first graph represents Nike's performance versus the industry's. Nike's liquidity ratio is above the industry average. This means Nike's ability to meet short-term debt obligations is fairly risky. Nike's best bet is to achieve short-term loans through third-party lenders. Although this next metric is displayed the smallest number on the graph, Nike's profitability ratio is twice that of the industry average. This is a key metric that makes Nike attractive. So essentially, for every $1 Nike generates of sales, they get to keep roughly 12 cents. Nike's low debt ratio and ability to pay back their debt allows Nike to negotiate interest rates, which provides a favorable situation during long-term loan processes. The inventory turnover ratio helps us define Nike's efficiency in managing and selling their inventory. The understanding of this metric is crucial, as it can help a company determine ways to increase sales via inventory management. As you can see on the graph, Nike's inventory turnover is at a 3.79, while the industry average is at a 5.24. Even though having a low inventory turnover ratio is fairly risky, there are logical reasons for the strategy. It could be seasonal inventory fluctuations, or maybe they're holding on to unwanted or obsolete inventory. But either way, this metric won't necessarily make or break your investing decision. So now let's dig a little deeper into some of these metrics and get a better understanding of Nike's position. This chart further breaks down Nike's liquidity over the span of the last 11 years. As you can see, Nike's current ratio has had a net decrease over this time span, and more specifically has drastically fallen over the past 3 years. Obviously, the higher the current and quick ratio, the more capable a company is to pay their short-term debt. A current ratio over 1 indicates a company's assets are higher than its liabilities. Nike has displayed a current ratio of 2.8 in 2016, which is an attractive metric for the industry. Solvency ratios focus on the financial health of a company and measures the ability to meet long-term debt and obligations. These ratios are most relevant for secured creditors who primarily are concerned in a company's ability to repay its long-term debts. Debt to equity is calculated as a total debt divided by the shareholders' equity. Nike's debt to equity ratio improved from 2014 to 2015, but it's starting to deteriorate significantly from 2015 to 2016. Debt to capital is calculated as total debt divided by total debt plus shareholders' equity. Nike's debt to capital ratio improved from 2014 to 2015, but also showed signs of weakness from 2015 to 2016. The last solvency ratio I will cover is the interest coverage ratio, which is calculated as earnings before interest and tax divided by interest payments. In all of 2014, 15, and 16, Nike's interest coverage ratio has improved. After analyzing these three ratios, it is evident Nike has been fairly conservative in achieving growth via borrowed monies, which in Nike's situation yields an attractive solvency rating. Profitability ratios are a measure of the company's ability to cover cost and generate a profit. This is what the owners, investors, and managers are really interested in. This is Nike's control point and the factor that gives them the edge on their competition in the industry. So all these financial statements and ratios seem to be validated by one number, the market price of Nike stock. At the end of the day, the market price of Nike stock is the main indicator of how Wall Street and investors value Nike as a whole. Nike has gone a long way since its IPO in December of 1980. When Nike first went public, it offered 2 million shares with revenues exceeding $269 million. Today, Nike is traded at just under $56 a share with a total market capitalization of $90.88 billion. Nike is known for the quarterly dividend payments, as they declared 62 cents per common share in 2016. Nike's annual dividends has increased all in the past 8 years with a yield of 1.3% and a payout ratio of 30%. In Nike's history as a publicly traded company, it has experienced 6 stock splits. Although these splits don't directly change the market capitalization, it highlights Nike's confidence and causes a more affordable stock, which is appealing to smaller investors. This also increases demand, which inevitably causes stock prices to rise. After close investigation of Nike's audited financial statements and of key financial ratios, it is evident Nike's stock is undervalued by about $5 to $9. Calculations for these estimates are shown on the above slide. Thank you for joining me via video. Now let's take it back to my real life group members.